Welcome to the deep dive. I'm looking at a pretty massive stack of notes today.
Yeah, it is a dense one.
It really is.
Yeah.
And it details something that is quietly but entirely rewiring the underlying infrastructure of global finance.
Right. It is happening under the radar for a lot of people.
Exactly. We're focusing on this massive revolution in yield. Specifically, we're looking at tokenized private credit and really the broader integration of real-world assets, or RWAs, into digital ecosystems.
Which is such a massive topic right now.
It is. And, if you follow digital assets at all, you are well aware of the cyclical hype trains that just roll through this space.
Oh, absolutely. The boom and bust cycles.
Right. But we're setting all of that speculation aside today. Our mission for this deep dive is to uncover the actual architectural mechanics of why institutional players, high-net-worth family offices, and crypto-native funds are suddenly doubling down.
Aligning their capital allocations toward real-world assets.
Exactly. Why are they doing it?
Well, it is a structural transition. I mean, we are moving away from the era of experimental, highly inflationary tokenomics.
Wild West phase.
Yeah, the Wild West. And we are entering a phase where blockchain technology is being aggressively applied to actual collateralized cash flows.
Real money. Real businesses.
Precisely. The migration of capital we are seeing right now, it isn't based on retail sentiment. It is based entirely on operational efficiency.
Which brings us to our sources. To guide this exploration, we are pulling directly from an exclusive industry briefing by Blockchain Ledger News.
It is a phenomenal briefing.
It really is. Specifically, we are looking at their inaugural episode titled Tokenized Private Credit. We're going to meticulously break down the mechanics of yield generation, the legal and structural stability of these assets, and the on-chain transparency making all of this possible.
Because without transparency, none of this matters.
Right. By the end of our discussion today, the goal is for you to have a crystal clear understanding of how this infrastructure upgrade could impact sophisticated investment strategies over the next decade.
It is a complete paradigm shift for anyone allocating capital.
Okay, let's unpack this. Why is private credit suddenly commanding so much attention at the intersection of traditional and decentralized finance?
What's fascinating here is that the asset class itself is not new.
Right. People have been lending money to companies forever.
Exactly. Private credit has been a foundational pillar of institutional finance for decades. So we aren't looking at the invention of a novel financial instrument here.
We aren't reinventing the wheel.
No, we are replacing the road the wheel drives on. We are witnessing a complete overhaul of the settlement and administrative rails of a multi-trillion-dollar market. Private credit is essentially undergoing a systemic upgrade, moving from analog, fragmented ledgers to unified, programmable networks.
Let's set the historical context for you, because to understand why this technological upgrade is happening right now, we really have to look at the macroeconomic shifts that bloated the private credit market in the first place.
You have to look back to 2008.
Right. The briefing traces the origin of this modern boom directly back to the aftermath of the 2008 financial crisis.
The 2008 crisis is the critical pivot point for everything we are discussing today. Post-2008, the regulatory environment for traditional banks underwent a seismic shift.
They were heavily penalized and heavily restricted.
Exactly. Frameworks like Basel III introduced incredibly stringent capital requirements. Banks were forced to de-risk their balance sheets.
Meaning they had to hold on to safer assets.
Right. They had to hold more high-quality liquid assets and heavily reduce their exposure to anything deemed high-risk or illiquid.
So they couldn't just lend freely to mid-sized businesses anymore.
No. Consequently, traditional commercial banks systematically pulled back from middle-market lending, specialty finance, structured credit, and direct lending to small and medium-sized enterprises.
The compliance burden simply made those loans unprofitable.
Unprofitable or just too capital-intensive for a regulated bank to hold.
And this is the crucial part for you to understand, the underlying economic demand for that capital didn't just evaporate.
Businesses still needed money.
Exactly. Middle market companies still needed growth capital, bridge loans, and equipment financing. So if the traditional banking sector stepped back, who stepped into the void?
The void was rapidly filled by alternative asset managers, private equity firms, and dedicated credit funds.
Because they play by slightly different rules?
Exactly. Since they were not subject to the same strict deposit-taking banking regulations, these institutions could step in and supply the debt that the banks were actively turning away.
They became the new engines of corporate lending.
They did. That structural shift birthed the modern private credit boom. Fast forward to the present day, And this is no longer a niche alternative strategy.
Not at all.
We are looking at a market estimated to be well over $1.7 trillion globally.
Trillion, with a T.
With a T. It has fundamentally replaced the traditional bank syndicated loan market for a vast swath of the corporate world.
I have to play devil's advocate here, though. If this market has grown to nearly $2 trillion and it is generating consistent yield for these massive credit funds, why do they care about the back office technology?
That is the big question.
Right. If these institutions are successfully matching capital with borrowers and printing returns, why rock the boat with tokenization? If it isn't broke, why fix it?
That is the core paradox of modern private markets. It is generating yield, yes, but the operational friction required to generate that yield is staggering.
It is messy behind the scenes.
Incredibly messy. When you look under the hood of how these multi-million-dollar loans are actually administered, it is remarkably archaic. The friction eats into margins, it delays the deployment of capital, and it severely limits secondary market liquidity.
So they are losing money to inefficiencies.
Massive amounts of money. They aren't adopting tokenization because it is novel or cool. They are adopting it because the current administrative drag is no longer sustainable as the market scales to this size.
Looking at the notes here, the sheer operational drag is detailed quite clearly in the briefing. They outline 5 specific pain points of traditional private credit. And when you read through them, it really paints a picture of an industry running on the financial equivalent of a telegraph system.
It is wild when you contrast it with how modern the rest of our digital lives are.
Exactly. Imagine trying to run your high-speed digital life, but the backbone of your investments is running on dial-up internet. The first pain point they highlight is the reliance on paper contracts.
Which sounds absurd in the 2020s.
It really does. In an era of algorithmic high-frequency trading, the fact that bespoke, multi-million-dollar credit agreements are still managed as static text documents is just hard to wrap your head around.
It is an immense bottleneck. These credit agreements are highly complex, legally binding documents. They often span hundreds of pages with intricate covenants, payment schedules, and collateral definitions.
But they're just dumb tech.
Exactly. Because they are static documents, whether we are talking about physical paper in a filing cabinet or a digital PDF on a server, they possess zero self-executing logic.
They can't do anything on their own.
No, they require human beings to read them, interpret them, and manually action every single clause.
So if a rate changes.
Right. When an interest rate shifts based on a SOFR benchmark, or when a borrower hits a specific revenue covenant, a human analyst has to manually calculate the implications and initiate the corresponding workflows.
Which naturally feeds into the second major pain point identified in the source, slow settlement. Because if the core logic of the asset is trapped in static text, moving that asset or even distributing the yield from that asset involves a gauntlet of human intermediaries.
Precisely. In the traditional syndicated loan market, settlement times are notoriously sluggish.
We aren't talking about T+1 or T+2 settlement like you see in public equities.
Not even close. We're often looking at T+10 or even T+20 days for a trade to fully settle.
Up to nearly a month just to move a digital representation of debt.
Yes, because you have administrative agents, legal counsels representing both the buyers and the sellers, and compliance teams all manually verifying the assignment agreements.
Checking all the boxes.
Every single party is checking KYC and AML statuses, confirming the transfer of funds across different banking rails, and updating their own localized systems. The velocity of capital is glacial.
And while that settlement is dragging on, you have the third major headache, manual reconciliation. I was reading a piece of the briefing that touched on this, and the duplication of effort across the industry is mind-numbing.
It is the definition of redundant work.
Every single participant in the life cycle of that loan is maintaining their own separate database.
That is the fundamental flaw of the legacy financial architecture. There is no shared state.
Everyone have their own spreadsheet?
Exactly. The originator has a database, the administrative agent has a database, the custodian, the paying agent, and the end investor all have their own proprietary ledgers.
So when money actually moves,
let's say a borrower wires their monthly interest payment. That cash hits the administrative agent's bank account. An operations team then has to manually calculate the pro rata distribution for every LP in the fund.
Manually calculating who gets what fraction of a penny.
Right. Then they initiate separate wire transfers and update their ledger. Then, every single receiving institution has to reconcile that incoming wire against their own internal projections.
And if they don't match?
If there's a discrepancy of even a single cent, It triggers a cascade of emails, phone calls, and manual investigations just to figure out whose spreadsheet is wrong.
The overhead costs associated with that manual reconciliation alone must be astronomical. Think about the thousands of operations professionals employed globally just to ensure that Bank A's spreadsheet matches Fund B's spreadsheet.
It is a massive drain on capital.
And because the asset is so cumbersome to manage and transfer, we hit the fourth pain point: limited liquidity. Private credit is famously an illiquid asset class.
Highly illiquid.
You are generally locked up for the duration of the fund, which could be 5 to 10 years.
And that illiquidity is a direct consequence of the administrative friction we just talked about. If it takes 3 weeks and thousands of dollars in legal fees to transfer a piece of a loan, there's simply no viability for an active secondary market.
It is too expensive to trade.
Right. So investors demand a significant illiquidity premium to lock their capital up for that long.
They need to be paid extra for the inconvenience of being stuck.
Exactly. Now, if you could strip away the friction of transfer, you could theoretically compress that illiquidity premium, which alters the fundamental pricing dynamics of the asset entirely.
But the fifth pain point is the one that seems to generate the most friction between the funds and the end investors. And that is opaque reporting.
The dreaded quarterly reports.
Right. We live in a world where data is instantaneous. You expect real-time analytics on your public equities, commodities, and FX markets. You can open an app on your phone and see what Apple stock is doing right this second.
But not in private markets.
No. Yet, for a multi-million-dollar allocation to a private credit fund, the standard reporting mechanism is a delayed quarterly PDF tier sheet.
The quarterly PDF is a symptom of the fragmented database problem we just discussed. Because the data is siloed across originators, servicers, and administrators, aggregating that data into a coherent performance report is a monumental manual task.
It takes some weeks just to compile it.
By the time the data is collected, verified, formatted, and finally distributed to the LPs, it is inherently stale.
It is ancient history in financial terms.
Exactly. Investors are effectively making portfolio allocation decisions based on a snapshot of where their money was 3 months ago.
Which is terrifying if you think about how fast markets move.
They have zero real-time visibility into the current health of the underlying collateral, the specific payment behavior of the borrowers, or the granular performance of the loan pool. It is a massive structural blind spot.
This is where the transition to blockchain infrastructure begins to make complete logical sense. The briefing shifts from diagnosing these legacy inefficiencies to outlining the tokenization solution.
And it is a very elegant solution.
It is. And the core argument here is that placing these assets on-chain isn't just a marginal iterative improvement.
It's not just a faster horse.
Right. It is a paradigm shift that systematically eliminates the 5 pain points we just mapped out. Here's where it gets really interesting. We're entering the era of programmable assets. Let's really break down how the tech stack solves the operational drag.
The shift to programmable assets fundamentally re-architects how financial value is managed. When an originator tokenizes a private credit loan, they are creating a digital representation of that legal agreement on a distributed ledger.
Using smart contracts?
Typically utilizing smart contracts, yes. And these aren't just digital receipts. They are active, autonomous pieces of software.
So let's look at the first pain point. Paper contracts.
Right. By encoding the terms of the credit agreement into a smart contract, the static text becomes dynamic, executable code.
The software literally runs the loan.
It does.
So the smart contract absorbs the administrative logic. But how does that interact with the actual movement of money? If a borrower makes a payment, how does the smart contract know to execute if the money is moving through traditional analog banking rails?
Well, that is the critical bridge. The most efficient implementations of tokenized credit utilize stablecoins or tokenized bank deposits for the actual payment leg.
So the money itself is digital.
Exactly. The borrower repays their principal and interest using a stablecoin, sending it directly to the smart contract address.
They aren't wiring it to a bank account at JP Morgan.
No, it goes directly to the contract on the blockchain. Because the payment rail and the asset ledger are native to the exact same blockchain environment, the execution is atomic.
Atomic meaning instant and simultaneous.
Yes. The smart contract receives the yield and, based on its encoded logic, automatically and instantaneously routes the exact pro rata share of that yield to every single wallet address holding a tokenized fraction of that loan.
Which completely bypasses the administrative agent.
Entirely.
There is no operations team manually calculating distributions on a Tuesday afternoon. There is no batching of wire transfers. And there is no delay. The asset itself performs the distribution.
Exactly. And because the asset is natively distributing the yield on a unified, public, or permissioned blockchain, it instantly resolves the manual reconciliation problem.
Because everyone is looking at the exact same data.
The on-chain ledger acts as the single immutable source of truth for all participants. The originator, the custodian, the auditor, and the end investor are all looking at the exact same state of the ledger simultaneously.
You don't have to call someone to ask what your balance is.
No. When the smart contract distributes the yield, the transaction is cryptographically verified and recorded on-chain immediately. The need to cross-reference localized databases vanishes because there are no localized databases.
Network is the database.
The network is the database.
The implications for auditing and compliance are staggering. But it also fundamentally alters the investor experience regarding reporting. The briefing notes that real-time on-chain data replaces the quarterly PDF.
Goodbye to the 90-day lag.
Right. If the loan state, the payment history, and the yield distributions are all logged immutably on a public ledger, you don't need to wait for a fund administrator to compile a report.
You can track the performance of your capital with the same fidelity that you track a package delivery.
Just refreshing a web page.
Anyone with the appropriate permissions can query the blockchain and see down to the second if a borrower has made their interest payment, if the collateral ratios are being maintained, or if a loan has entered default.
You move from trust-based reporting to cryptographically verifiable reporting.
The transparency is continuous.
And because these are digital tokens residing on a unified ledger, fractionalization unlocks liquidity. You solve the slow settlement and the illiquidity in one single stroke.
Yes, you can take a massive asset and chop it up.
Exactly. You can fractionalize a $50 million corporate loan into thousands of smaller tokens.
And those tokens can be traded on secondary markets with near-instant settlement.
No more T plus 20 days.
Because the token and the payment leg, the stablecoin exchange, hands simultaneously on the same network, which we call atomic settlement, counterparty risk is practically eliminated.
You don't have to worry that the other guy won't send the money.
Right. You don't need 3 weeks and an army of lawyers to reassign a piece of the debt. The smart contract handles the transfer of ownership and the routing of future cash flows automatically.
It fundamentally changes the liquidity profile of the entire asset class.
It does.
This brings us to a conceptual framework in the briefing that I found incredibly compelling. They refer to it as the Holy Trinity for investors.
I love this framework.
It really clarifies things. When allocating capital, especially in the alternative space, investors are perpetually searching for the optimal balance of 3 core elements: yield, stability, and transparency.
And historically, you had to sacrifice at least one of those.
Exactly. You could have yield and transparency, but no stability. Or stability and yield, but no transparency. Tokenized private credit, according to the source, delivers all 3 simultaneously.
If we connect this to the bigger picture of how the digital asset market has evolved over the last few years, this Holy Trinity is the exact catalyst driving institutional adoption right now.
Let's compare it to the past. Let's look at the early iterations of decentralized finance, or DeFi.
The DeFi summer.
Right. During the boom of 2020 and 2021, investors were achieving astronomical yields.
20, 30, sometimes 100% APY.
But those yields were largely synthetic. They were generated by inflationary token emissions, circular borrowing mechanics, or highly speculative algorithmic models.
They possessed transparency because they were on-chain.
And they definitely offered yield.
But they possessed zero stability. There was no real-world economic activity underpinning those returns.
It was a house of cards. The moment the speculative server cooled, those yields collapsed because they weren't tied to fundamental cash flows.
Right.
Tokenized private credit completely flips that model. The yield isn't coming from a governance token being printed out of thin air. It is coming from a real-world business paying interest on a loan.
It is fundamentally tethered to traditional economic activity.
That is the stability component of the Trinity.
You are dealing with loans that are often over-collateralized by real-world assets. We are talking about real estate, corporate revenue streams, physical machinery.
Things you can touch.
Things you can liquidate. You have legally enforceable claims to those assets in the event of a default. You are combining the rigorous underwriting and structural stability of traditional corporate credit with the yield generation of a multi-trillion-dollar market.
And the third pillar, transparency, is provided by the blockchain infrastructure we just discussed. The on-chain reporting gives you the verifiable proof of that yield and stability.
When you synthesize those three elements, you create what the industry is now referring to as the safe yield of Web3.
It serves as the ultimate bridge between two historically siloed financial ecosystems.
TradFi and DeFi.
Right. Traditional finance possesses the stable, real-world collateral and the legal frameworks, but it suffers from antiquated technological plumbing.
The PDFs and fax machines.
Exactly. Decentralized finance possesses the most efficient, transparent, and composable settlement infrastructure ever created, but historically lacks stable real-world backing.
Tokenized private credit connects the two.
It imports the stability of TradFi onto the high-speed rails of DeFi.
Think about the implications of this for your own investment thesis.
We were talking about the exact moment that traditional yield becomes fully programmable. How does your strategy shift? When you can access the predictable cash flows of a middle-market corporate loan, but you can interact with it using the speed and composability of software.
It completely alters the parameters of alternative investing.
It really does.
It also eradicates the geographic limitations of capital allocation, which is perhaps the most disruptive element discussed in the briefing. By moving these assets onto borderless ledgers, we are witnessing the globalization of private credit.
The briefing provides a highly specific scenario to illustrate this, and we need to walk through the mechanics of it, because it makes the abstract very concrete. Historically, the private credit market was intensely regional.
Very localized.
It was relationship-driven. If a mid-sized logistics company in Chicago needed a $20 million loan to expand its fleet, they went to a localized credit fund.
A fund based in Chicago or New York?
Right. And the LPs backing that fund were likely regional institutions or domestic family offices. The capital was geographically trapped by the friction of cross-border syndication.
The administrative overhead of syndicating a bespoke middle-market loan across international borders in traditional finance is prohibitive.
It is a nightmare.
You are dealing with differing regulatory jurisdictions, complex cross-border KYC and AML requirements, correspondent banking fees, and severe FX risk due to settlement delays.
Because if a trade takes 20 days to settle, currencies can fluctuate wildly in that time.
Exactly. Because of this friction, the liquidity pool available to that Chicago logistics company is restricted to whatever capital happens to reside within its immediate localized financial network.
But the briefing notes that tokenization essentially shatters that geographic trap. Under the new paradigm, that $20 million loan originated in Chicago is underwritten, structured, and then tokenized on a public blockchain.
It is fractionalized into digital tokens.
Now, an investor sitting in Singapore, operating in a completely different time zone and a completely different banking system, can purchase a fraction of that loan within minutes.
The mechanics of that transaction are what make it revolutionary. The Singaporean investor doesn't need to open a U.S. brokerage account. They don't need to navigate the SWIFT network or worry about the FX volatility that might occur during a T+10 settlement window.
They skip all of that.
They simply interact with the smart contract using a dollar-pegged stablecoin. The smart contract automatically verifies their on-chain identity and compliance credentials, executes the atomic swap of the stablecoin for the tokenized debt instrument, and records the transaction immutably.
The entire cross-border settlement happens in the time it takes to mine a block.
Mere second.
The implications of that borderless access are profound. We are talking about connecting localized yield opportunities to massive global liquidity pools. For the investor in Singapore, Tokyo, or London, they gain frictionless exposure to the highly stable dollar-denominated yield of U.S. industrial credit.
An asset class they previously couldn't access without massive intermediary fees.
And we must look at this from the borrower's perspective as well. Because the Chicago logistics company is now tapping into a global reservoir of capital rather than a localized puddle, the cost of capital fundamentally changes.
Basic supply and demand.
Right. When you increase the supply of liquidity, competing for the asset, the borrower can often secure more favorable terms.
Lower interest rates for the business.
Exactly. The sheer expansion of the total addressable market for both borrowers and lenders is why institutional capital is accelerating into this space. The market isn't just migrating, it is opening up globally.
And this acceleration brings us to the concept of the RWA flywheel.
This is a great section of the notes.
The briefing meticulously details the momentum of this adoption cycle. In market dynamics, a flywheel occurs when a specific sequence of events naturally reinforces and accelerates the next step in the sequence, creating compounding momentum.
A snowball effect.
Right. The source material outlines the specific stages of the tokenized private credit flywheel.
Let's break down all the steps. It is a textbook liquidity momentum model. The cycle begins with the fundamental demand side. Investors are actively searching for reliable, non-correlated yield.
Especially in high interest rate environment.
Right, that persistent demand is the initial catalyst. The second step is the technological application. Tokenization is introduced as the mechanism to provide more efficient, frictionless access to that yield.
Which leads to step 3. As that efficiency is proven out, originators and issuers recognize the benefits. They see the expanded global reach and the compressed settlement times, so they begin tokenizing a larger volume and a wider variety of their loan portfolios.
They put more product on the shelf.
Exactly, which naturally feeds into step 4. As the supply of high-quality tokenized assets increases on-chain, it acts as a massive magnet for institutional capital.
The big players show up.
Larger funds, who were previously waiting on the sidelines for the ecosystem to mature, enter the market because there is finally enough volume to justify their massive ticket sizes.
And as that institutional capital flows in and interacts with the increased supply of assets, we hit step 5. Secondary market liquidity deepens. We transition from a theoretical market to an active, robust trading environment.
You can actually buy and sell without moving the price too much.
Exactly.
Step 6 is where the market truly matures, and this is the phase that institutional analysts watch closely. This is yield stabilization.
Right, because early on, things are volatile.
In the nascent stages of any novel financial technology, you often see erratic yields. There is a novelty premium or an illiquidity premium that early adopters capture. However, as the flywheel spins, liquidity deepens, and billions of dollars of institutional capital flood the pools, those risk premiums compress.
The wild fluctuations smooth out.
They smooth out and the yields stabilize into highly reliable institutional-grade returns.
And because the yields are now stable, proven, and backed by robust liquidity, the final step is triggered. A massive sustained influx of mainstream capital.
The floodgates open.
The cycle then cheats back into itself. The demand for stable yield drives more tokenization, which deepens liquidity, which attracts more capital. The momentum becomes entirely self-sustaining.
The briefing draws an incredibly astute historical parallel here to the rise of ETFs, exchange-traded funds.
Which are everywhere now.
But they weren't always. If you analyze the trajectory of the first ETFs in the early 1990s, like the SPDRS and P500, they faced immense skepticism. The traditional market didn't immediately grasp the structural advantages of an ETF.
It was too new.
But once the underlying infrastructure was hardened, the regulatory frameworks were established, and the authorized participant mechanism for creating liquidity was understood. Adoption exploded. ETFs fundamentally democratized access to diversified liquid equity portfolios.
They reshaped the architecture of the stock market. You literally cannot discuss modern equity markets without centering ETFs. They unlocked an entirely new paradigm of capital flow.
Precisely. And tokenized private credit is cracking that exact same historical trajectory. It is democratizing access to private market yields in the same way ETFs democratized access to public equities.
But with a major difference in speed.
There is a crucial distinction. Because this infrastructure is being built on digital native, globally accessible, 24/7 blockchain networks, the RWA flywheel is spinning exponentially faster than the ETF revolution did. The time compression of this adoption curve is just unprecedented.
Okay, we have established the macroeconomic drivers, the technological solutions, the global implications, and the sheer velocity of the market momentum. But here is where we need to slow the conversation down significantly.
We need to look at the risks.
Absolutely. If you are an investor looking at this space, how do you navigate it? How do you separate a structurally sound tokenized asset from a poorly constructed one? The underlying technology is revolutionary, but a blockchain does not magically transform a high-risk loan into a safe one.
Garbage in, garbage out.
Exactly. So what does this all mean for you practically? The briefing provides a rigorous 5-point evaluation checklist. This is the learner's checklist for evaluating any tokenized private credit opportunity, and we need to spend serious time unpacking the mechanics of each and every point. I suggest you mentally write this down.
This is unequivocally the most critical segment of our analysis today. The transparency of the blockchain can sometimes create a false sense of security. You are looking at a pristine, perfectly coded smart contract, but you must remember that the smart contract is merely a wrapper around a real-world, off-chain economic agreement.
If the off-chain reality is flawed, the on-chain token is worthless. Let's meticulously analyze the 5-point framework the source provides.
Number 1 on the checklist is underwriting quality.
The fundamental questions here are, Who originated the loan, and what is their historical track record? How does off-chain underwriting translate into on-chain risk?
You have to peel back the technological layer and look at the human element of the credit analysis. The blockchain does not perform due diligence on a borrower's balance sheet.
It can't visit a factory and inspect the operations.
Exactly. It does not analyze a company's EBITDA, evaluate their management team, or stress test their cash flow projections against macroeconomic headwinds. That underwriting is performed by credit analysts at the originating firm.
Human beings.
Human beings. Therefore, the most critical variable is the pedigree of the originator. If you are evaluating a tokenized pool of maritime shipping loans, for example, you need to know if the originator has a decade of verifiable experience in the highly cyclical maritime industry.
What are their historical default rates?
What are their typical loan-to-value or LTV ratios? If the token is being issued by a newly spun-up decentralized autonomous organization or a tech-first startup with no proprietary data or historical track record in credit risk modeling.
The risk premium on that asset is astronomically high.
Regardless of the smart contract's security, the tech cannot save a fundamentally bad loan.
Which leads directly into point number 2, collateral structure. Is the loan secured, and what is the specific recovery process? Let's dive really deep into this because the intersection of digital tokens and physical collateral is where things get highly complex.
Collateral is your ultimate downside protection. In the private credit markets, you have unsecured debt, which relies entirely on the corporate entity's ability to generate cash flow.
Basically, a promise to pay based on their future earnings.
Right. And then you have secured debt, where the loan is legally collateralized by specific assets: real estate, heavy machinery, accounts receivable, or intellectual property. The distinction is paramount.
Because if things go wrong.
In a default scenario, secured creditors have the senior legal right to seize the physical collateral, liquidate it, and recover their principal. But here is the critical nuance for tokenized assets. How does a decentralized network of anonymous token holders actually execute a physical liquidation?
Right. A smart contract cannot drive a tow truck to Ohio and repossess a commercial tractor. It has zero physical agency.
Exactly. This requires a robust off-chain legal framework that is legally bridged to the on-chain environment. You must investigate the legal entity acting as the trustee or the security agent on behalf of the token holders.
Who is doing the physical repo?
And have they properly perfected the security interest? In the US, for example, have the UCC1 financing statements been filed correctly, naming an entity that represents the token holders as the secured party?
Because if that paperwork isn't filed, you aren't actually secured.
You are out of luck. Furthermore, how is the valuation of that collateral communicated to the blockchain? This is where Oracle networks come into play. Are there independent third-party oracles continuously feeding audited collateral valuations into the smart contract?
If the mechanism for off-chain enforcement and on-chain valuation is opaque or undefined, you do not have secured debt.
You have an unsecured promise wrapped in a shiny digital token.
That is a phenomenal distinction. The legal bridge is everything. Moving to point number 3, on-chain transparency. The checklist asks, are the payments, the defaults, and the ongoing performance actually visible on-chain? This speaks to the danger of what some call tokenization theater.
Tokenization theater is a massive risk right now.
Explain that for us.
Many traditional institutions want the marketing cachet of blockchain without fully committing to the radical transparency it requires. So they will issue a token that represents a share in a traditional opaque credit fund.
But they hide the actual data.
Exactly. The actual loan level data, the specific payment schedules, the identities of the borrowers, the non-performing loan ratios remains hidden off-chain in their private centralized databases. They issue the same old quarterly PDF and simply represent your ownership with a token.
That defeats the fundamental purpose of the technological upgrade. It is just a digital wrapper on an analog process.
Exactly. True on-chain transparency means the asset utilizes the ledger for operational truth. You should be able to access a dashboard or query the smart contract directly and verify the exact moment a borrower's stablecoin payment hits the protocol.
You should have real-time visibility into the health of the loan pool.
You should be able to mathematically verify the proof of reserve. If the issuer is demanding blind trust and shielding the granular performance data off-chain, you must treat that asset with extreme skepticism. The ledger must be the source of truth, not a marketing gimmick.
Point number 4 is liquidity. The checklist mandates evaluating if there is an active secondary market. We discussed earlier how tokenization unlocks the potential for liquidity, But that doesn't mean liquidity automatically exists the moment a token is minted.
That is a crucial differentiator. Theoretical liquidity and actual market depth are two very different things.
Just because you can trade it doesn't mean anyone wants to buy it.
Precisely. Just because an asset utilizes the ERC-20 standard and can technically be transferred in seconds does not mean there is a willing buyer on the other side of the trade. When evaluating an investment, you must analyze the secondary market infrastructure.
Are the tokens trading on decentralized automated market makers or AMMs?
If so, what is the total value locked in those specific liquidity pools? Will a sizable sell order incur massive slippage, destroying your yield? Alternatively, are they traded on permissioned institutional order books?
If the market is too thin, you are effectively holding an illiquid asset, regardless of the digital wrapper. You must assess the empirical trading volume.
We have arrived at point number 5, the final checkpoint, and perhaps the most important, the legal wrapper.
The source asks, is the token backed by an SPV, a trust, or a registered fund? Let's spend some dedicated time dissecting this because the legal architecture is the absolute bedrock of the entire system. What exactly is an SPV, and why is the concept of bankruptcy remoteness the ultimate safety net for an investor?
SPV stands for Special Purpose Vehicle. It is sometimes referred to as an STE, Special Purpose Entity. This is a foundational concept in traditional structured finance that has been directly imported into tokenization.
What does it actually do?
An SPV is a completely separate, distinct legal entity. It is often formed as an LLC in a jurisdiction like Delaware, or a foundation company in the Cayman Islands. And it is created for one singular purpose: to hold the specific loans or assets being tokenized.
And nothing else.
Nothing else. The reason this is non-negotiable comes down to the concept of bankruptcy remoteness.
Walk us through a hypothetical disaster scenario to illustrate why bankruptcy remoteness matters. Because I think that makes it click. Let's say I invest in a tokenized credit pool through a highly reputable tech-forward platform.
Let's run that scenario.
Yeah.
Suppose a massive fintech platform originates the loans, they build the incredible user interface, and they write the flawless smart contracts. You purchase their tokens.
Okay, sounds good so far.
If that platform did not use an SPV, meaning the loans are just held as assets on the fintech company's own corporate balance sheet, and the tokens are essentially just liabilities.
You are exposed to the platform's overall corporate risk.
Completely. If the fintech platform mismanages its venture capital runway, gets sued, or files for Chapter 11 bankruptcy, your investment is now fully entangled in their bankruptcy proceedings.
The court could freeze everything.
The court could freeze all assets, including the loans your tokens represent. You could take a massive loss, even if the underlying corporate borrowers are perfectly healthy and actively making their loan payments. Your risk is tied to the platform, not the asset.
That sounds like an absolute nightmare, and it completely negates the point of investing in stable yield. You thought you were buying a safe loan, but you were actually betting on a tech startup.
It happens all the time when structures are poor. Now, let's run the exact same scenario with the proper legal wrapper.
With the SPV.
Yes. The fintech platform originates the loans, but instead of keeping them on their balance sheet, they execute a true sale of those loans into a newly formed SPV.
So they sell them off to this separate entity.
The SPV now legally owns the debt. The tokens issued to you represent a legal claim on the assets within the SPV, not the fintech platform. The SPV is structured to be bankruptcy remote. It has its own directors, its own bank accounts, and its own legal standing.
So if the fintech platform files for Chapter 11 in this scenario,
the SPV is entirely insulated. The platform's bankruptcy has absolutely no legal bearing on the assets held within the SPV. The corporate borrowers continue to make their payments into the SPV's accounts.
and the yield keeps flowing.
A backup servicer steps in to manage the administrative duties, and the yield continues to flow to the token holders without interruption. The underlying asset is perfectly ring-fenced from the operational failure of the technology provider.
It fundamentally shifts your counterparty risk. You aren't betting on the survival of the tech platform. You are strictly taking risk on the underlying credit performance of the loan pool.
Precisely. Whether the legal mechanism is a Delaware statutory trust, a specialized fund structure, or an SPV, you must demand absolute clarity on how your digital token establishes a legally enforceable bankruptcy remote claim to the real-world cash flows.
If the legal wrapper is vague, legally untested, or entirely absent, the most sophisticated smart contract in the world cannot protect your capital.
It cannot.
That breakdown is incredibly empowering. It arms you with exactly what to look for. And I want to loudly echo the strict rule the briefing attached to this 5-point checklist. If any of these points, underwriting quality, collateral structure, on-chain transparency, liquidity, or the legal wrapper, if any of them are unclear, undefined, or opaque, you must pause.
Do not deploy capital.
Do not deploy capital. The allure of frictionless, high-yielding, programmable assets is powerful, but it should never blind you to the fundamental, immutable rules of credit risk.
That is the golden rule of this entire transition. The underlying financial principles of risk and return remain absolute. The technology is merely an execution layer. Demand rigorous clarity on all 5 points before you interact with these assets.
We have covered immense intellectual ground today. To synthesize our core thesis, the private credit market is not simply migrating to the blockchain. It is being fundamentally re-architected.
Built from the ground up.
We are taking a $1.7 trillion market burdened by static paper contracts, T+20 settlement delays, and opaque quarterly reporting, and we are systematically upgrading it with autonomous smart contracts, instant atomic settlement, and cryptographically verifiable on-chain transparency.
And the momentum we are witnessing indicates that tokenized private credit is not a cyclical trend. It is a permanent structural transition.
It is here to stay.
It marks the historical inflection point where private markets transition into global, borderless networks, and where real-world assets become the undeniable collateralized backbone of the digital financial system. The flywheel is spinning, institutional capital is deploying, and the infrastructure is hardening.
I want to leave you with a direct question straight from the briefing, a call to action for you to consider as you survey the financial landscape. What specific sector of the RWA ecosystem are you most intrigued by?
There are so many avenues.
Are you fascinated by the tokenized corporate credit we dissected today? Are you watching the tokenization of U.S. Treasury bills, serving as the base layer of digital risk-free yield? Or are you looking at tokenized commercial real estate? The surface area of this technological upgrade is expanding rapidly, and it is well worth determining where your strategic interests align.
This broad adoption raises a profound question, and I want to leave you with a final thought from the source material to mull over. Throughout our discussion, we noted that the traditional private credit market was historically built almost entirely on regional, geographically constrained human relationships.
The handshakes.
It was an industry of handshakes, long-standing trust, and localized networks. If those localized human relationships are now being systematically replaced by global, borderless smart contracts, algorithmic execution, and verifiable on-chain transparency, what does the future of trust look like in a programmable world?
That is a deep question.
Is trust eventually reduced entirely to audited code and mathematical certainty, or will there always be a fundamental need for a human handshake, even in a hyper-efficient digital pipeline moving capital from Chicago to Singapore? It is a philosophical shift that will redefine the nature of financial counterparty risk.
What a brilliant tension to end on, the balance between verifiable code and the human element of finance. Thank you so much for joining us on this deep dive. Our hope is that you walk away from this discussion feeling equipped, highly informed, and ready to navigate this quiet revolution in global yield. Keep questioning the infrastructure around you and stay curious.
1, 2, 2.